8 out of 12 tells you that there is a lot of dissent in the ranks that Powell really put a pretty picture on. Good for him. The market interpreted it as liquidity's coming down the pipeline. We're going to have zero interest rate policy all over again, and risky assets are going to go bananas and haywires. Unlike a year ago, in order to keep this AI bubble inflating, you've got to borrow to do it. So people, they want to look away from AI right now and say, what about the S&P equal weighted index? Maybe all stocks are going to do well. If interest rates are falling, it's really a sad reflection because you sit there listening to Powell talk about we're making monetary policy for everybody, and yet somehow, some way, it only seems to benefit the top 10%.
Danielle DiMartino Booth returns to the show once more. She's the CEO of QI Research and a former Fed insider. The Federal Reserve cut their Fed funds rate by 25 basis points today. This was a well-telegraphed move, but markets took it as good news. The stock market's up. The S&P rises. The NASDAQ rose about 30 basis points. Gold's up 50 basis points. Bitcoin is down, though, slightly. But more or less, the stock market's taking this as very good news. We're going to find out why and what's next for monetary policy in 2026 with Danielle. This video was sponsored by Kalshi, one of the largest prediction markets in the US. It's a fully regulated platform that lets you trade on real world events from economic data to political outcomes. Go to Kalshi, link down below, kalshi.com/r/Lynn, or scan the QR code here to get started. Use the promo code LIN, L-I-N, and new users get $10 when they deposit $100. Welcome back to the show. Danielle, good to see you. You've also penned an open letter to the Fed, and we're gonna talk about
indeed.
that. Yeah,
sure.
So
my manifesto is going viral, David. It's a good day in my world.
It's time for a leadership change. Waiting for President Trump to force the stripping of the Fed's independence is not an option. At stake is the salvation of the America envisioned by our founding fathers. This was released today. Obviously, you didn't write this. I don't know if you wrote this morning. When did you write this? You released it today.
I wrote it yesterday morning. I woke up at 4:04 a.m. and it was just burning a hole inside of me. So I wrote it.
Well, very timely release on the morning of, or the afternoon of the Federal Reserve Market Open Committee decision. So let's talk about what happened today. Given that former Chair Powell, given that Powell is a former.
David.
Oh no, I'm sorry. That's not what I meant. That's not what I meant. Given that Powell warned that the economy has gone into this kind of slowing down phase for the for the labor market, and given that we know that he's going to get replaced, evaluate why the markets took this as more or less good news. Was there a projection that they signaled that signals looser monetary policy ahead, or is it just the market factoring this maybe Powell's last?
Well, Powell's got 3 more meetings in 2026. We're certainly not rid of him yet. But I think really it was the news that the Fed was going to be starting on December the 12th, injecting $40 billion into the markets. That was the minute he mentioned that during the press conference, the markets immediately interpreted this as being, oh, we've got QE around the corner. Here comes Fed liquidity. Yay, let's celebrate. And so that really was what set the market off. And of course, if the Fed is theoretically even potentially at the precipice of launching another round of QE, even though this was all explained as being just to keep the plumbing functioning, make sure there's ample liquidity in the market. We don't want to go back to not QE from 2019, but the market interpreted it as liquidity's coming down the pipeline. We're going to have zero interest rate policy all over again. We're not going to be debating 25 or 50 basis points, into 2026. We're going to force the Fed into injecting gobs of liquidity into the financial system, and risky assets are going to go bananas and haywires, and bond yields will come down. And indeed, when we before the market opened today, the 10-year bond yield was at 4.20%. It's at 4.14% at the close today. It is off to the races, David. Or at least that's the interpretation. It
was brought to my attention that people that I talked to said this was probably the best Q&A that they've heard in a while. I don't know if that's an opinion or sentiment you share, but take a look at one of these questions here.
Is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. You've got one tool; it can't do two things at once. So, at what pace do you move? What size moves do you make, and that kind of thing, and what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
What do you think?
Well, look, he can say all he wants about there being camaraderie and cordiality around that great big oval table in the Eccles building. But, there were 8 Federal Reserve district presidents, 8 out of 12, who voted against lowering the discount rate. And that is the rate at which banks can access emergency funding from the discount window at the Fed. 8 out of 12 voted against it. That's a lot of dissent. And of course, this was Jeffrey Schmidt's last FOMC vote. He dissented, of course. That was a hawkish dissent. That was his last vote for 3 years. Today was Austin Goolsby's last vote for 2 years, because we're going to have Beth Hammack rotate in from the Cleveland Fed. We know she's a huge hawk. We've got Lori Logan coming on from the Dallas Fed. We know she's a big hawk. And we've got Neil Kashkari coming on from the Minneapolis Fed. And well, he's, however the wind is blowing is how he typically votes. He's fairly malleable. But 8 out of 12 tells you that there is a lot of dissent in the ranks that Powell really put a pretty picture on. Good for him.
What do you think about inflation right now? I'll get to your. I'm going to get your opinion first, and then I'm going to show you or describe what Powell said.
So I think inflation right now, the fact that a year ago that Powell was talking about services inflation and, super core CPI, things that we were talking about last year. Now he's talking about services disinflation. And I think what we need to focus on, Trueflation this morning printed at 2.51%. We need to focus on what's driving inflation. What's driving inflation is I've got a data center in my backyard and my utility bills just doubled. And my food costs are higher than what they need to be. None of these things the Fed has control over. But again, he noted services disinflation. That means that people do not have enough money after covering their essential costs, rent, food, utility bill. We've got utility bill defaults going through the roof, David. That means I think at least Powell was implicitly acknowledging that the inflation over which the Fed has control is under control.
Is that reflected in the bond markets right now, do you think?
I certainly think that the bond market is in fact, my good friend Anna Wong at Bloomberg Economics came out today and said that she anticipates disinflationary pressures to build into the first half of 2026. That's certainly what we see, again, outside of what you're spending to cover what you have to pay, the roof over your head, the food on the table, keeping the electricity on. Those costs are definitely not under control.
This is what Powell had to say. Take a listen to this. This is kind of a bombshell statement from him.
If you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing the most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both.
Okay, wait a minute. I don't know if he's doing this because he knows he's out soon, but he that's just point blank. It's Trump's fault.
Oh yeah, and when he was asked, so what is going to cause your GDP forecast to increase next year versus in 2025, he was like, well, AI is a great thing, and that's it's raising productivity. He did not make one mention of one big beautiful bill. So, he remains, David, I'm sorry, he remains extremely, extremely political right now. It's one of the reasons that I wrote this manifesto that I did.
Right. All right. So what is next for the Fed? How will we expect, this is the last FOMC meeting before the end of the year, right? How can we just, in broad layman terms, expect the Federal Reserve to change policy, to change stance, change attitude towards the administration next year in 2026? And then we can talk about market implications.
Well, I mean, I think the market is right now, at least, interpreting what the Fed is suggesting, really just one more rate cut in 2026. I don't believe that. The Fed actually spoke out of both sides of its mouth today. It said that there were downside risks to the labor market, and yet, it's anticipating that the unemployment rate going into the new year is going to fall. Look, whoever Trump picks, and Trump keeps saying, my pick is imminent, and then he pulls back and says, I'll let you know by the first of the year. Whoever the pick is for Trump is obviously going to be interpreted, at least, as the direction that rate cuts are going to take. But again, every time he seems to have a candidate, David, he backs away from that candidate. Reason bond yields went up this week is because Kevin Hassett started off the week in an interview on CNBC saying that he doesn't see a way to make monetary policy 6 months out. In other words, he sounds like Powell. It's a meeting to meeting, live meeting basis. That probably, that might have kicked him out of the running to be Fed chair.
This is from Cowsheet, it's a prediction market. So the percentage that, the chance that Kevin Hassett is going to be Fed chair next, 69, it went down a little bit actually. So this is according to prediction markets. Kevin Warsh, number 2, Christopher Waller, number 3. Any of these particular gentlemen here who are potential nominees, who of these people are most dovish, do you think?
I think I think Hassett is certainly more dovish than the other two are. In fact, if Waller was as dovish as Hassett, then he would have dissented along with Stephen Myron today in favor of a 50 basis point rate cut. He did not. So I think the interpretation is that Hassett is certainly the most dovish of all of them. But again, look at that green line. It came down a little bit after the interview that he did that made it sound like he wants to try and at least, prevent the evisceration of his integrity by being a total Trump yes man.
What is your view on Trump and tariffs overall at this point in 2026? Well, beginning of 2026, end of 2025, do you think trade wars will de-escalate from here? Is it still necessary to fight multi-front wars when it comes to trade?
Well, I mean, I guess where you are, it is. In Canada, that seems like the only place where the trade war continues to rage. But no, I mean, we've seen Trump back off of most of the tariffs. We're seeing him being very conciliatory with Xi Jinping in China. And it doesn't really matter because China's managing to get goods into the United States, if not directly from China. They're doing it through a conduit nation. But no, I think the markets have really looked past tariffs and moved on to whatever the next subject might be.
What is the next subject? What is the next theme for 2026 if you had to put a finger on it?
Everybody wants to know who's going to be chair of the Fed, which in my view is absolutely irrelevant if people on the Federal Open Market Committee would actually exercise their right to vote.
I know you've said that the end of QT, quantitative tightening, does not mean that we're going to have QE, but I'm just going to pull up a statement that I read. This was shared on social media. So this is from Decisions Regarding Monetary Policy Implementations, last updated December 10th. One of the things, bullet points here, I've got: increase the system open market account holdings of securities through purchases of treasury bills and, if needed, other treasury securities with remaining maturities of 3 years or less to maintain an ample level of reserves, effective December 11th, 2025. The FOMC directive. What does that sound like to you?
That's exactly what we started talking about when we first started talking today, David. The markets are interpreting that as some form of QE light that will hopefully culminate in full-blown QE. I think what market participants are not quite appreciating is that for the Fed to get to full-blown QE, there has to be some kind of an economic calamity. I mean, you don't start QE unless you're at the zero bound. And we're sitting here debating 25 basis points, 50 basis points. We're talking about going from 350 to zero and quickly and relaunching full-blown QE. I was at a cocktail party last night for the holidays here in New York, and somebody was saying, we could easily see the balance sheet go to 9-10 trillion. Market participants are already anticipating QE from the Fed. And in their view, it was validated today because the Fed's going to start buying Treasury securities again with maturities of less than 3 years.
If the Trump administration wants the Fed, or Kevin Hassett in particular, to try to manipulate or control the 10-year yield, which is to say, somehow do something to make government debt even cheaper, how would they do that if that's even possible?
Well, now, David, now you're talking about QE. You're talking about full-blown QE because you're going further out than 3 years on the curve.
Okay. So that we really need to see that before that happens. The reason I brought that up is because a lot of bond vigilantes are a little bit scared about the unwinding of the Japanese carry trade, but we'll see what happens with that. Okay, with that said, Danielle, what are some of the biggest market moving factors going into 2026 besides the Fed, where perhaps federal monetary policy remains top of mind?
Well, I think actually now that it's been, the government shutdown lasted a lot longer than the government shutdown when you think about the data that we have not had. So I think people are going to be laser focused, next Tuesday when we finally get a non-farm payrolls report. I think the market's going to be focused on data going into 2026 because the earnings picture, while still expected to be a good thing, now we know that unlike a year ago, in order to keep this AI bubble inflating, you've got to borrow to do it. So people, they want to look away from AI right now and say, what about the S&P equal weighted index? Maybe all stocks are going to do well. If interest rates are falling, maybe that $8 trillion in money market funds, maybe that's going to start looking for a new home with a higher yield, or they're going to be dividend paying stocks that are going to be attractive in the new year because senior citizens are going to be looking for a place to pick up yield as the Fed funds rate has fallen by 175 basis, almost 2 percentage points of interest income has come out of the pockets of savers at this point. So I think there's going to be a lot of focus in the new year on the real economy and on companies that can pay real dividends.
We've talked about this before, you and I on the show several times, the K-shaped economy. So this is manifesting apparently in Christmas shopping. So the wealthy driving retail demand while everybody else is not. And I wonder how that's going to translate to actual sales numbers, margins, and growth in the real economy. Eventually, this has to stop, no? Or perhaps it'll continue indefinitely and we'll have 10% driving up the entire economy.
Well, it's worked so far, David. I mean, it's really a sad reflection because you sit there listening to Powell talk about, we're making monetary policy for everybody, and yet somehow, some way, it only seems to benefit the top 10%.
Finally, have you taken a look at the dot plots? You've told me before it doesn't really matter to you, but dot
plot didn't change one bit.
No,
dot plot did not change for 2026.
Yeah.
I mean, there's really nothing remarkable in the dot plot. What was much more interesting, again, was that 8 Federal Reserve district presidents voted against lowering interest rates. I mean, I think one of the biggest stories of next year is how much dissent. Well,
you read my mind. I'm going to finish off on this one question. What happens when we do get more dissent in the Fed? What political fallout ramifications can we expect from that?
Markets tend to not like dissent unless it's accompanied by $40 billion in purchases of treasuries with maturities of less than 3 years. But you can easily name 3 immediate Federal Reserve District Bank presidents that are going to vote for the first time on January the 28th. You could have 3 hawkish dissents and 1 dovish dissent with Stephen Myron's last vote before his 4-month term ends on January the 31st. Markets don't like dissent, and they want to have faith in a strong Federal Reserve chair.
Okay, we'll put the social media links down below where we can follow you. Where can we follow you, Danielle?
So you can follow me on, the social media platform formerly known as Twitter. That's certainly where you can find my open letter manifesto. And, going into the new year, we're running a lovely little promotion for our for new subscribers. So please come to DiMartinoBooth.substack.com. And if you're an institutional investor, QI Research.
Okay, we'll put the links down below. So make sure to follow Danielle. Thank you very much for your timely update. Always appreciate you having on or coming on the show during Fed Day.
Absolutely. Happy holidays.
Okay, thanks for watching. Don't forget to follow Danielle in the links down below. Don't forget to subscribe, and don't forget to use my promo code LIN, L-I-N, when you use Kaushi. Go to the link down below, kaushi.com/r/Lin, and you'll get $10 when you deposit $100 for the first time.